Candlestick price charts are a way of displaying price action during a trading session. I call it a way because there are multiple ways. There are different types of price charts. But the purpose of this mentorship is to speed track your journey to making money in the market. So I don't need to teach you all the ways of displaying price action. I need to show you the way of displaying price action, if you know what I mean. And that is candlesticks. It's a very simple concept. Candlesticks give us data, right? So in a trading session is just the period between, when the market opens and people can start trading, and when the market closes and people can't trade anymore. And that's a trading session. So during that trading session, price, as we've seen before, price of an asset will fluctuate, right? So it would go up or down in to different degrees. And these candlesticks, they show the high, the low, the close, and the open price within a certain period of time. So let's say in 5 minutes or 10 minutes, if you look at a candle that formed in 10 minutes, it will show you the highest price that was reached in 10 minutes, the lowest price that was reached, the close at the end of the 10 minutes, and the open price. So that was the price when the 10 minutes started counting. Now, this is what a candle would typically look like. A candlestick you see this big section of the candlestick, this big blue section, that's called the body. So that's the body of the candle. And these skinny black lines that you see at the bottom and at the top of the candle, that is called a wick. WICK, a wick. So this candle, and this is the basis for every single candlestick, this candle gives you information. So a part of the candle, which will be the top of the body, will show you the open, which is the price, which is the level that price was at when the trading started. So say this candle is a 5-minute candle. That means that this was the price, this area, this top where this arrow points to, will be the level that price was at when the 5 minutes started counting. Now, this long skinny wick above it represents the highest point or the highest price that was reached within those 5 minutes. Then the bottom of this body, right here, delineated by this arrow pointing to it, shows you the close. So that shows us what price was at when trading stopped at the end of the 5 minutes. That's what it means by close. And this skinny wick below it, all the way to the bottom, will show you the lowest price that was reached within those 5 minutes. Now, there's another way or another visualization of this candle I want to show you, right? And this visualization is in terms of volume. So I want you to know that in every candle, because the candle represents trading, or should I say price action, within a certain time frame, you have to understand that buyers and sellers interacted. So there were buy orders injected into the market and there were sell orders injected into the market within that time period. So when you look at a candle, if you look to the top left, this diagram on the top left of my arrow is at now, this big white block here represents a candle also. It represents the body of a candle. Remember I said that the big section inside is the body. Just like here, this is the body. So this body will always have institutional volume. Volume will always be inside of the body. The volume of orders will always be inside of the body. What I mean by that is, because there was price action occurred inside of this candle, because buyers and sellers interacted, a lot of times there will still be buyers populated inside of this candle. or there will still be sellers populated inside of this candle. So if price were ever to return back to this candle, those orders can easily be executed. Now, it's important to know that candlesticks are color coded. Color coded means that on every single price chart from now till the end of your trading career, as far as technical analysis is concerned, every single price chart that you'll ever look at will have two different colors. Two different colors of candles. So one color will always be depicting a scenario where buyers were stronger, and the other candle's color will always be depicting a scenario where the sellers were stronger. So in a scenario where the buyers were stronger, we call those candles up close candles. And why we call them up close candle is because, remember the diagram of the candle I showed you previously? Where the candle opens will always be below its close. Or in other words, the candle will always close above its open. That's how you know it's an up close candle. And the other color of candlesticks will represent down close candles. That's where sellers were stronger. And in that scenario, the candle's close will be below its open. So say at the start of the trading session, the price was at $10. At the end of the trading session, the price is now $6. The candle that depicts that trading session will be a down close candle because the opening price, which was $10, was above the closing price, which was $6. And I'll show you the diagram here. So this is what I mean by color coded. On every price chart, there will always be two different colors of candles. So in this scenario, we have one candle that is blue and we have another candle that is white. They still tell us the same information, except one candle will be a down close candle and the other candle will be an up close candle. So down close candle represents seller's strength, up close candle represents buyer's strength. Down close candle, the opening price is above the close. Down close candle, the close is obviously and observably below the open. Principle for down close candle. Reverse scenario for up close candle. Go look up to the top left of your screen. The up close candle. The candle close is above its open. Look at the white candle. The diagram of the white candle. Literally above it says up close candle. Pay attention to it. Look at where it opens. The open is below the close. Or in other words, the close of that candle is above the open. That means where price closed at the end of that trading session was above the open. If price started that trading session at $10, when it closed, price was at $17. It went up. Now, another price action pattern I want to introduce you to is the concept of a pullback candle. So if you look to the top right of your screen, this diagram where we have 4 white candles. This is a diagram for a pullback candle. So what is a pullback candle? Well, basically, when price moves, it trends upwards. It trends upwards in a series of higher highs and higher lows, if that's an uptrend. If it's a downtrend, you know it trends downwards in the series of lower highs and lower lows. So here we see the first up close candle. We see from the diagram here, we know that the up close candle opens at the bottom and closes at the top. So here we see two on the diagram to your right. See where price opens, closes. The next candle also opens, closes higher. The next candle opens, closes higher. So the concept of a pullback candle, if you observe the next candle, which is the last candle, do you observe that it doesn't close higher than the previous candle? It is the only one that failed to close higher than the previous candle. It could not trade beyond that previous candle's high. That is a pullback candle. And I want to reinforce this down close candle theory. I told you candlestick charts are always color coded. So if you look to the bottom of that chart, now where we have a blue candle, after three up close candles, we now have a blue down close candle. Do you see that even though price was going up, it was trending upwards, and then we had a down close candle, that down close candle still traded beyond the previous candle's high? But it's blue because where the price opened is higher than where the price closed at. Do you see? So say on this down close candle, off the top of the head, price opened at $12. It ended up closing at $10. At some point in that trading session, price definitely was higher than the previous candle, but ended up closing lower. So this is a down close candle. Now, this down close candle is not a pullback candle. A pullback candle and a down close candle are not the same thing. Do you see from these two charts that the difference, put this in your notes, guys, because I'm only going to say this once. The difference between the pullback candle and a down close candle is that a down close candle can still trade beyond the previous candle's high. But it is a down close candle and will also have a different color because the close of that candle, the close of price at the end of that trading session will be lesser than the opening price of the trading session. Unlike a pullback candle will not trade beyond the previous candle's high. So yes, it is possible for you to have a down close candle that is a pullback candle, but they are not the same thing. Play that back and listen to it to gain more understanding. Market phases. So on a very broad, like beginner terminology, the markets only have three phases, right? Like when you look at a price chart, price can only move in three directions. It's either the price is moving upwards, or price is moving downwards, or price is moving sideways. So it's either price is trending upwards, it's an uptrend, or price is in a downtrend, or price is in a range. That's what we call sideways motion. It's called a range. Now, when price trends, I said this in the previous clip, when price trends, when it moves up or when it moves downwards, it doesn't just shoot up perpendicularly like in a 90-degree angle. It doesn't just drop down like a needle. It moves up in a series of swings, and those swings form higher highs and higher lows. So it's by recognizing that you know that, oh, the price is in an uptrend. And in a downtrending situation, price will create a series of lower lows and lower highs. So if you look at the diagram to your right now, I've introduced you to a chart. You can obviously see the top diagram where we have four blue candles. We have 4 down close candles. Remember I told you a down close candle is a candle where the opening price is higher than the closing price. In other words, at the end of the trading session, price dropped. Price fell from where it had opened at. So we had 4 blue candles, right? Do you notice how each successive candle's low is lower than the previous candle? Look at it for yourself. Pause the video. Each candle's low is lower than the previous candle's low. And if you also notice, the high or the top of each candle is lower than the previous candle's high. That is how you identify, ladies and gentlemen, if price is trending downwards. In such a scenario, we say price is in a downtrend. Now, if you look at the diagram below it, where we have 4 white candles, 4 up close candles. By now, you should know what up close candles are. Do you notice how the top of each candle is higher than the previous candle's high? So the top of each candle, the top of each successive candle is higher than the previous candle's top. And if you pay closer attention, you also notice that the bottom too as well. As the candles continue to move and progress from the first one to the second one to the third one, the bottom of each candle was higher than the bottom of the previous candle. Okay, ladies and gentlemen. So this is how you identify or should I say an uptrend in the market. Now, this is where we get real technical, because I'm the type of person, right? I really love to ask questions, and I'm very curious. And I know that those of you who are here too, you are the same. That's why you're watching this video, and that's why you will succeed. And that has led me to discovering even more detail about the phases that the market can be in. Okay? So like I said earlier, in broad terms, the market only moves in 3 phases: up, down, and sideways. But now I want to introduce you to more. So the first phase I want to talk about is when the market is in an uptrend. We have a breakout phase. So a breakout phase is a parabolic movement upwards. Is a lethargic movement upwards. Price just shoots up. You just see up close candle, full body up close candles, just moving up. In this type of situation, buyers are in complete control and the market is imbalanced and sliding to one side. And another phase that the market can be in when it is moving up, another way the market will move up is the market moves up in a tight bull channel. So a tight bull channel is also price action that is bullish and is moving general direction upwards. As you can see, when this movement started, it started at this bottom, and when it ended at this top. But do you notice how in that price swing, in this movement, price forms little retracements, little tight retracements. So we call that a channel, right? But it is tight because those retracements are not deep enough for you as a short seller to make money. If you notice that every retracement quickly gets killed and price goes to run higher than the previous top. As you can see here, from this high, low, and then price ran it. From this high, low, price ran it. From this high, for sellers to come in again, sellers try to make money on this candle and price runs them out. So in a tight bull channel, you want to still be buying and you only want to be buying. Another phase that the market can be in is a broad bull channel. And a broad bull channel is also a way that the market can move upwards. But here you see that the market moves, it starts its movement from the bottom of this chart and ends up at the top of this chart, all the way up here. But in that up move, there are swings. So the market moves up lethargically and then swings back down and forms the double bottom here, right? And then you have another lethargic move upwards, and then you have a long period of retracement from this top back down. And then you have another move upwards, lethargic move, and then you have a long retracement from another double bottom. Then you have another move upwards. So this is another way that the market can move upwards. It's still a channel. You can draw two trend lines to consolidate this, two parallel trend lines to consolidate this. It's still a channel, but the retracements are deep enough for you to take sell positions and make money. They are also deep enough for you to take profits as a buyer and get in at a discount. Again. So here you can buy, you can also sell during broad bull channels when the market is in that type of phase. And the last phase we talk about is a range. A range is sideways motion where price is consolidating, basically consolidated between a high and a low. So in this situation, you can see that unlike all the previous three diagrams I've shown you, here price is not swinging upwards. It is not lethargically moving up at any point. It's not lethargically moving down at any point. It is just choppy, sideways. Okay? So you can also trade this type of market conditions. Here you can buy the lows and you can sell the highs. We'll talk more about this later. So we got the breakout, the bullish breakout. You have a very strong momentum to the upside. This bullish breakout, you only want to be buying. You can buy for any reason. You can buy the close of the candle. You can buy the first candle close. You can buy the second candle's open or it's closed. You can buy the third candle's close. You can buy the fourth candle's close. You can buy the fifth candle's close and so on and so forth. And you'll still be making money. So in breakouts, you can buy for any reason because there's strong momentum to the upside. This type of price action occurs early on in trends. So when the market is starting to trend upwards, that is when you see a breakout. As the trend matures, you are less likely to see breakouts and more likely to see channels. Now, during bullish breakouts upwards in situations like this, do not sell the market. You do not want to be taking sell positions. You will get burnt. You will lose money. Last thing I want to talk about, this type of price action breakouts, they don't last very long. So they can be lethargic. You can have 10 candles that may give you 100 points on the NASDAQ. 10 candles that may give you 200 points on the NASDAQ. But that will happen in maybe 15 minutes. And after that, you would have another many hours of consolidation or slower price action. So breakouts don't last very long. Type bull channels. Now, type bull channels are also a bullish price action upwards. Type bull channels, they are breakouts on higher time frame. So yes, you remember the previous charts I just showed you of lethargic moves up? This type bull channel that you see in this diagram, if you were looking at this on the price charts and you went and clicked the button and went to a higher time frame to observe that same price action, this thing that will appear to you as a type bull channel will appear to you as a breakout on the higher time frame. During type bull channels, because it is a breakout on the higher time frame, you also don't want to be selling the bullish breakout. The same way you don't want to be selling a bullish breakout, you also don't want to be selling a tight bull channel. And during type bull channels, you should look to buy the lows with limit orders of candles. You should look to buy the low of candles. when you see these retracements, so in this diagram, you see how price rallies up, and then you see this first down close candle, and then the succeeding one closing lower. You can buy that low, knowing that this initial white up close candle, buyers bought that, and they had their stops under it. So price coming in and reaching their stops, that's a buy. You can buy that low. Price rallies up, this down close candle, and then you see another up close candle here. You can buy this low with a limit order when you see this type of thing. So you don't want to be selling tight bull channels. Look to buy them. Broad bull channels. They have weak upside momentum. So I told you earlier on that breakouts happen earlier in the trend. Broad bull channels will occur later on in the trend. Broad bull channels are weak upside momentum. So buyers are still in control, but there is enough selling pressure for you to have meaningful retracements. We're talking about 50%, 60% retracements on that swing. You primarily want to be long in a broad bull channel market. When the market is in this phase, you should be taking up long positions. Why? Although, yes, you can have meaningful short positions, because the direction of the orders is net long, because the market is trending upwards. The market, because of it is trending upwards, the market is going to look to have impulse swings to the upside, meaning that there's potential for larger profits if you are taking long positions, because the market is going to make new higher highs. If you're taking a short position, you expect the market to go lower, but if the market is an uptrend, what does it do? It makes higher highs and higher lows. So it is not going to go lower. Instead, it is going to make a new high and a new higher low. So you would eventually get burnt. So which is why you want to primarily be long. But at the same time, you can also capitalize on the short swings. That's why I said retracements are deep enough for short positions. Now, the market phase, for the bearish point of view, for the sellers, is essentially the same thing, but the roles are reversed. So now here we have a breakout. The market is breaking out to the downside, and you see a lethargic move down with big down close candles. You have a tight bear channel. A tight bear channel is also a way that the market will move downwards. This tight bear channel will create impulsive moves downwards. You see minor retracements upwards, but primarily direction is down. This type bear channel will also be a breakout on a higher time frame. So you don't want to be buying tight bear channels, you want to be selling tight bear channels. Broad bear channels. So this is another phase that the market will be in. The market will swing and make impulsive legs downwards, but it will have meaningful upward move retracements large enough for you to take counter trend trades and take profit. But ultimately, order flow is bearish and the market wants to move lower, so you expect the trend to continue. And then we have a market range. Again, choppy movement. Price is not breaking out to either side of the market. As a matter of fact, in a range, price is more likely to stay in a range. Probability for price to stay in a range is actually higher than the probability of the market breaking out from the range. So when the market breaks out of a range, you can actually do the opposite of what that direction entails. So if it breaks out to the top, you can actually sell that breakout, because the probability of the market returning back into the range is higher than the probability of the market breaking out of that range. Now, in a bearish breakout market, where you have lethargic moves downwards, big down close candles succeeding one another, you have strong downside momentum. It occurs early on in downtrends, So it occurs early in downtrends. You want to sell the close of the candle, so pay mind to the down close candle here, and what you want to do is you want to sell this close or sell the close of this down close, or you can sell the close of this down close. Essentially, when the body of the candle ends up closing real close to the low of that candle, it shows that there's a lot of sell volume in that candle and price is likely to continue lower. So you want to look to sell at if you can get at that same price. You do not want to buy during bear breakouts, and bear breakouts don't last very long. Tight bear channels. Tight bear channels is another another phase of the market where selling program is taking place. And tight bear channels are breakouts on higher time frames. Like I said earlier, you don't buy tight bear channels because they are breakouts. They are, downtrending breakouts on the higher time frame, and you want to look to sell the highs of candles, expecting the trend to continue. So every time you have a retracement upwards, you want to look to sell the high of that retracement. Now, broad bear channels are selling programs where you market is still moving downwards and you have impulse swing downwards, but you have retracements deep enough upwards for you to make meaningful profits, taking a counter trend trade. But the general direction of the market is still downwards, so you expect the trend to continue. Now, the momentum downside is there and selling pressure is there, but is weaker than in a breakout or in a tight bear channel. Primarily short positions, you can take long positions as well, but you expect that the downtrend to continue, so you have bigger risks to rewards you have a bigger reward on trades that are in line with the downtrend. And retracements are deep enough though for long positions.